Okay, welcome to our webinar on business assurance, where we will be discussing estate planning for your business. It's important to plan for succession and in order to extrapolate value from your business. And we welcome our guest speaker, Dwight, who is a senior legal marketing specialist at Liberty Life, who supports the sales force as well as any specialist team on all legal aspects of financial planning in the life assurance and wealth management industry. Dwight actively engages in training and research on estate planning, retirement planning, and business assurance planning. He graduated from the University of Pretoria with an LLB degree and from the University of the Free State with a postgraduate diploma in certified financial planning. And just to remind you that this webinar is not financial advice. In order to get specialized financial advice, kindly book a meeting with our financial advisors at Spectra by following the links on our website or on our emails. And with that, over to Dwight to explain the intricacies of business assurance and what business owners must be aware of and what we as financial advisors take into consideration when advising clients. Thank you, Dwight. Over to you.
Right. Thanks so much. Yeah, and thank you for your time, and for the guest, thank you for your time. My name is Dwight, and I'm going to be discussing the following points with you guys with regards to business assurance. If you've got questions, you're more than welcome to stop me and to ask your questions to make sure I don't lose you. And yeah, and if you would like a copy of this presentation, I'm more than willing to share it with you guys. I can send you a copy of this at any stage. Okay, so we're going to be chatting about contingent liability assurance, buy and sell, something that we call the living buy and sell, key person, and preferred compensation. So it's actually all just fancy names, but it's pretty easy to understand it once you start dealing with these type of things. Okay, the first one is called contingent liability. So the problem that most businesses face is when they start up a business, they're going to require finance. Where do we get finance? We need to go 90% of the time, we need to go to the bank and ask for finance. What will the bank require us to do? If I'm a business owner, it's going to require me to sign security for the amount that I'm borrowing from the bank. Okay. So problem with this is what happens if one of the business owners become deceased or disabled? Will it have an impact on the business? What about the remaining business owners that are left behind? And what about family relatives? Okay, the family relatives of the deceased or the disabled business owner. So when I am applying for this debt or this loan from the bank, there's usually two rights that I have. This is my protection. So the first one is called the right of excussion. So this compels the bank or the credit provider to first seek legal action against the borrower. Who borrowed the money? The business, not me as a shareholder. Second one is called right of division. So this applies when you share suretyship with one or more people. Okay, so I can demand that the debt is split between all the other shareholders. So this is like protection for myself as a shareholder. Generally, all of your rights will be waived if you sign a suretyship agreement with any bank, not just Standard Bank, any bank. So there's going to be no protection for the shareholder when he or she applies for finance. Okay. So if the bank wants their money or requires a repayment of all the capital, the problem is they can go to the business and ask it, and then if failing which, they can go to the business owner and demand that payment, which can be dangerous for the business owner. So the solution for this is what we call contingent liability assurance. So this is where your business takes out a policy on your life. Okay? So in the event of your death or your disability, any life insurance company will pay a capital amount to the business, and the business can use the proceeds of that policy to settle the outstanding debt with the bank. Okay, so the company will be the owner of the policy. The company will pay the premium on the policy. The life assured will be usually the business owner or a director. The beneficiary will be the company. Okay. The premiums payable by the business is not tax deductible. So this basically means that if the director or shareholder becomes deceased and R1 million pays over to the company can use that million to pay Standard Bank or whatever bank. There will be no tax on that R1 million because you didn't receive any tax benefit. Okay. Unfortunately, in our tax law, or let me call it insurance law, if you have a life policy on your life, it will be regarded as a deemed asset in your state. Okay. So this policy will attract estate duties, unfortunately. So what does it basically mean? So if you die as the life assured, the life insurance company will still pay that R1 million to your company. The company can settle the debt with the bank. However, the person that became deceased, his executor will go to the business and ask for a little bit of estate duty. Let's call it 200,000, for example. Okay, SARS wants a portion of that. And there's unfortunately no getting away from that. Okay, so what I do is I structure these policies for the business clients, and I also give you a agreement. So the agreement is going to state, the agreement is going to compel, it's going to compel the business to use the proceeds to settle any outstanding liabilities that he or she might, or that the business might have with the bank. Okay, that's all done free of charge. So what is the advantage of this type of policies? Money is available to settle the debt. Okay, so when the bank comes knocking for their money at the door, my family will be protected. So I'm no more here. I'm deceased. I My family doesn't need to worry about the bank coming to my estate and demanding R1 million or 500,000 or whatever the case may be. I know policy paid out and the bank is sorted. So my family is financially secure. Second advantage, protects the company in ensuring the credit lines remain open. Okay, company doesn't have any more debt, credit lines can remain open, they can apply for more debt. Protects the individual surety's estate from liability. So I know that my personal estate is totally secured or exempted from the suretyship that I sign on behalf of the business. So my family is not going to be affected by by um, by potential liability. Okay, and this is just a summary of what I've just discussed on the structure of the policy. So this is a business-owned policy, a company-owned policy. The individual doesn't benefit. The process is payable to the business. Okay, there is unfortunately death taxes on this policy. So I can tell you out of my head, I can automatically calculate the death taxes. So let's say, for example, there's R1 million policy on my life. I can already tell you there's 250,000 payable to SARS on that policy. So if I want R1 million clean or net after tax, I technically need to take out a policy of 1,250,000. So the 250,000 payable to the receiver, the million is net after tax. Okay. There's no capital gains tax on these policies. Okay, so for contingent liability, is there any questions on this type of solution? Something that wasn't clear, or is it pretty simple to understand this specific structure or this product? Does it make sense or not? So the second one is one of our most sold products in business assurance, and it's something that they call a buy and sell. So, in my personal opinion, every business owner needs a buy and sell policy. And I'm going to explain to you in a minute why I say that. Okay. Biggest problem for business owners is death or disability. What's going to happen to your business interest? Will your spouse or your children inherit your business? Are your family members already involved in your business? And Do they have the necessary skills and experience to run this business if you are no more here tomorrow? How will your partners feel about working with your wife and your son and your daughter? Do your remaining partners have the necessary cash to buy your business interest out of your deceased estate? Okay, have they saved up for it, or do they have cover on your life for it? They're going to need money in order to buy your business interest out of your deceased estate. Okay, why is a buy and sell policy a solution? Okay, it's going to provide the people that remain behind with cash capital because they're going to need it. So if, for example, I am a business owner and the value of my business interest is R1,000,000. So the executive, the first thing he needs to do a valuation of my business interest. Whether it's a CC, whether it's a PTY, sole prop, it doesn't matter. It forms part of my stake. He's going to appoint an independent valuator. That independent valuator is going to charge him a fee to value my business. He's going to say, Mr. Executor, the deceased business interest is valued at R1,000,000. Why? Because it's an asset in my estate. Okay? And that potential asset could be subject to executors' fees, estate duty, and potential capital gains tax. Okay. So now the remaining people need R1,000,000 to buy out my business interest. Where are they going to get the R1,000,000? If they haven't saved up for it, they need to go to the bank and borrow it because my executor cannot just give them my business interest. Okay, there needs to be a contract, and that is the agreement that I draft for the clients. This agreement is gonna force the executor to transfer my shares in the PTY or my members' interest in a CEC to the remaining business owners. He's gonna be compelled to do it in terms of the contract that I sign. But you still need to pay for it. So the people that are still alive still need to pay R1,000,000, fair market value, R1,000,000 into the deceased estate. Okay. So now you don't have to deal with my wife or my kids. You bought out the business interest out of my deceased estate. And my estate also benefited because now, instead of the business interest in my estate, I'm now sitting with R1,000,000 in my estate. And that can go for my family. Okay. And you don't have to deal and fight with my family members. So how does a business interest tie into personal estate planning? This is how it ties into personal estate planning. So your business interest can be shares, members' interest, whatever the case, partnership. This will be regarded as property in your deceased estate. Once it's property in your estate, it will attract executors' fees. Executors' fees is payable at 3.5%. If the executor is registered for VAT and 90% of them are registered for VAT, the executor's fee is 4.025%. Okay? On the gross value of your estate. Business interest. Okay? It's also regarded as a deemed disposal in a deceased estate. Okay. So unfortunately in South Africa we have another type of tax called capital gains tax. We never had it in South Africa until October 2001. So, capital gains tax is also levied in a deceased estate. So, SARS is regarding you as having deemed of disposing of your capital assets. That tax is levied at 18%, only on capital assets. For example, business interest, immovable property, things that grow in value. Not all your assets in your estate will be regarded as capital assets. So they're not interested in jewelry, furniture, firearms, boats, nothing like that. Only things that grow in value. So the receiver was really clever when they introduced capital gains tax. Okay. Number 3, possible tax is estate duty. So your business interest is still property in your estate, and once it's property in your state, it could be subject to estate duty. Estate duty is levied at 20%. Okay, so can you already see all the costs involved by me just talking about your business interest? This is not even your house or your properties. This is nothing else, just your business interest. So 4.025% plus 18% capital gains tax plus 20% estate duty. What does this tell me? When a business owner becomes deceased, his estate is going to need a lot of liquidity, a lot of cash. And what does an executor do? He's going to open up an estate late checking account and he's going to cash in whatever liquid assets he has. For example, the cash in your bank account, unit trust investments, money market accounts. So I'm going to see what hard cash do I have. If I don't have enough cash to pay SARS, to pay all your liabilities, and to pay all your creditors, then I'm going to go and ask your beneficiaries to pay the cash into the estate. If they don't have the cash, what is the executor going to do? He's going to sell your assets by way of auction. Okay. And by assets, I mean your business interests, your immovable property, your vehicles, whatever he has listed in the estate as property. That's your risk. So that is what you don't want. You don't want any troubles with your estate liquidity. This is where your buy and sell policy will come into play. So in my previous example, I said I sold my business interest out of my estate for R1 million. So this is where that R1 million can come into play. So we can use that money to pay estate duties, pay capital gains tax, pay the executor, and there's one thing I left out, to pay my creditors. Might still happen that you have a bond. We need to settle that bond. Might still happen you have an overdraft. We need to settle that. Vehicle and asset finance, we need to settle that. Every liability has to be settled. Okay, so this is where this specific policy is going to help you or your estate to be liquid so we can pay everybody that needs to be paid in a deceased estate. This is why we sell these policies to business owners. Okay. So the main issues that we have with these type of products is business valuations. So I've seen many clients where we did buy and sell policies for R1 million. Next year, the business is valued at 2 million. So we need to increase the cover. The year after that, it's 3 million. Then we need to increase the cover. So unfortunately, the business will grow at a rapid pace and the policy will not keep pace with the growth of the business. And this is where we have to review you as a client just to make sure that we try and keep pace with the market value of the business. What we also do on these type of products, we put something that we call an annual benefit increase on the policy, which basically means that the R1 million life cover is going to increase each and every year with, for example, 10%, and then another 10%, and another 10%. So that your policy value can just try and keep track of your business value. Okay. We also provide the customers with a contract. These contracts can easily cost you 10 to 15,000 Rand. If you do it via us, it's going to be free of charge. Legal and binding, and we do review it each and every year. Okay. On the buy and sell, I also didn't hear any questions. So I'm going to assume that everyone understands that and everyone is happy with that.
Right, if I may ask, just for interest sake, when there's a loan account, the client actually has got a loan account owing money to the business. Is that now part of the buy and sell that we need to address, or could it be seen as part of the contingent liability?
Okay, so if the client is owing money to his business, it's a liability in his estate. So it's not contingent liability. So he owes the business. That's a debt. Are you talking about a debit loan account?
Yes.
Yeah. I'm owing. In fact, strange enough, I actually saw a client in Rustenburg. He owes his business 18 million Rand. He didn't even know about it. 18 million. He didn't believe us, but it's on his financial statements that he actually gave to myself and to the broker. And then I told him, Mr. Client, in the event of your death, this is a liability in your estate. And this liability needs to be settled. Needs to be settled. How do we address that liability? One of two ways. I can take out a personal policy on my life. That policy can become payable to my estate of 18 million rand. So in the event of my death, the executor can settle that 18 million rand hit over to the company. Second solution, the company can take out a policy on my life. So that's where the company is the owner of the policy. I'm the life assured. In the event of my death, 18 million rand is payable directly to the company in respect of the debit loan account. Does it make sense, Crystal?
Thank you.
Yeah, so I'm actually glad you mentioned that because with debit loan accounts also comes credit loan accounts. So this is where I injected money into my business, and this is what I see most of the time. So let's say, for example, the value of my business interest is R1 million. However, I also invested another R1 million into this business. Okay, so when I become deceased, the value of my business interest in my estate is R1 million, plus my credit loan account is also valued at R1 million. The business owes me R1 million. So, how do we get this business interest and the credit loan account out of my estate? It's only possible by way of a buy and sell policy. So the person or the persons buying out my business interest need to insure my life for 2 million and not 1 million. Because if they only insure my life for 1 million and buy out the business, they're still going to be stuck with a credit loan account that is going to be due to my wife. Because my will says I bequeath everything to my wife. So you only bought out my business interest, but you didn't buy out my credit loan account. And what's my wife going to do? She's going to come knocking at your door asking you to pay back the million that my husband, my deceased husband, invested in the business. Credit loan accounts must form part of all buy and sell agreements. Sorry. Okay, so that's the buy and sell. So with regards to buy and sells, there's different solutions for different clients, for different businesses. So we personalize these policies to make specific or to cater for the specific needs of a specific client. Okay. The third thing I also want to discuss today is something that we call a living buy and sell. And this is what we are beginning to see in practice, unfortunately. So we have this is where we have seen these clients. We've got their risk policies enforced, their buy and sell policies, their contingent liability policies for the debt of the business. Everything is sorted. Contracts are drafted. But now everyone is still alive. Okay. So now let's say one business partner is age 62. He's got 50% interest in the business. He wants to go on retirement. And he says, listen here, guys, fellow business partners, I want to retire. Please buy me out. Okay. That's a big problem because now the value of his business interest is 5 million rand. Where are we going to get the money to buy him out? He wants to retire. Okay. So what we could have done is an investment. That's what we could have done for all the business owners. And how do we do that from a tax efficient manner? Okay. So we enter into a contract, right? And this is between employer and employee. So this is a company and a shareholder, or a company and a director, or a company and a normal employee. Okay? We're going to give you a salary increase on condition that you use that salary increase to take out an investment. We call it an endowment policy. Okay. After the policy issued, We see that policy back to the business for security. Why do we do that? Because if I now pay these premiums for 3 years, after 3 years, I'm done, I resign, then I can just take that money and run away. If you do a security session, the employee or the shareholder cannot run away with the money. You have ceded your rights to the investment policy back to the business. Okay. So in terms of the agreement that we signed today, the proceeds must be used by the employee to buy the business interest from the business owner. The agreement can also state that should the employee resign before the policy matures, the employer can surrender the policy and keep the proceeds. So in case of your death or disability, so this is no breach of contract. The agreement can stipulate that your estate or your beneficiaries will receive the proceeds of the investment. So practically, the employee and the employer will first agree on a lump sum. And this is what we should have done for these type of clients. We agree on a lump sum we would like to achieve within 5 years or 10 years. Then we determine the premium that we need to invest for that term. After that specific term, we can cash in the investment and start buying out the major shareholder while everyone is still alive. That specific premium will form part of your fringe benefit tax. That will make it a tax deductible expense for the company. Okay, so in practice, I have seen a couple of clients around Gauteng, Mpumalanga, and Limpopo and the Northwest, and they have invested big premiums to make sure that they at least start saving money now and use those proceeds to start buying out people while they are still alive. Because we have no guarantee that the majority shareholder is going to become deceased within a year or 10 years or 5 years. He might still be living. Okay. And there's your tax deduction. So if it's 100,000 Rand salary increase a month, it's 1.2 million per annum. That entire 1.2 million is a tax deductible expense for the business. Okay. So I just want to give you an example. I'm not going to name any names. There's actually a brokerage, a very big brokerage that's sitting with this problem. So the brokerage is owned, the business is owned by one person. Okay? That person has 6 employees, but these 6 employees is basically running this business. Okay? If something happens to the business owner, they are going to be in trouble. So what we did is we did a buy and sell to make sure that if that business owner becomes deceased, they have enough money to buy that entire business out in equal shares. However, we did that 12 years ago, and that business owner is still alive. Okay. And now the employees paying the premium on that buy and sell is crying because the premiums are so high now, and that business owner is already in his 80s and he's still alive. So there's no solution for them. What we should have done is this also. We should have done the buy and sell plus this investment so that we at least have saved up some cash and we could have bought out this business owner proportionately. For example, 20%, 30%, 40% throughout the last 12 years they have been paying these premiums. Okay, that's what we actually should have done 12 years ago. It would have helped them now while everyone is still alive. So questions on the living buy and sell, or does it make sense? So this is basically an investment for the business owners, and it's a tax deductible expense for the business. So this is going to put cash in your pocket as a director or as an employee or as a shareholder to make sure that you have reserve funds that you can use to start buying out major shareholders. Okay, while he or she is still alive.
Dwight, we've got a question here. Does it make any sense to do something for a sole ownership of a business?
Yeah, strangely enough, so if it's a sole owner of a business, you see, you can still do it for a sole owner, but the reason I say you can do it, let's say it's a PTY. A PTY and a company and a shareholder are separate legal entities. So you can definitely do it for a sole business owner, but what's going to be the purpose of that? That's going to be to actually save up some funds for the shareholder in his or her personal capacity. So a company investment is a company investment. How do I get money out of a company? I either need to draw a salary and pay tax, or I need to declare dividend and pay dividend withholding tax, or I need to borrow the money. So this is going to be a good idea for the sole business owner to actually save up some funds for himself. Okay, it's his money, not the company's money. So it's actually a good idea to do this for a sole owner, to save up some type of lump sum or a monthly contribution for his personal investments. So absolutely.
Personally, would also consider using the same structure, but on a retirement annuity structure to get that tax benefit as well.
Yeah, absolutely. Absolutely.
I have a question.
Yes.
Yes, I'd like to know what or how the living buy and sell differs from preferred compensation.
Exactly the same thing. Exactly the same
Basically
thing.
the same thing.
Exactly the
Oh,
same.
okay.
You just use it for a different purpose.
Yes, yes,
So
yes,
it's
yes.
a good question that you're
Okay, got it.
asking. It's exactly the same structure. 100% correct.
Mm. Okay, thank you.
Okay. This product is called a key person policy. We also see a lot of these policies floating around in the different regions. And this is basically to ensure someone that is important to the business, to the profitability of the business. Okay. So it's not going to be applicable to a lawyer's firm where if one attorney becomes deceased, um, uh, uh, another one can merely just take over his files. So this is for someone that negotiates large contracts. He has a huge impact on the profitability of the business. Okay, the company can insure that specific business for an X amount. So the structure of this policy is exactly the same as the contingent liability policy. Exactly the same. It's a company-owned policy. Company pays the premium. Company is the beneficiary. The life assured is the key individual. Okay. So the key individual, there is nothing in it for him or her. This is surely purely the property of the business. The only difference between this policy and the contingent liability policy is the contingent liability policy, the business is going to use that money to pay back the bank. So the key person policy, the business is going to use this money to go and recruit another key individual or to train a new key individual. Okay. Second difference is with this policy, the premiums that the business pays, if you choose so, the company can claim the premiums back from SARS as a tax deduction. If you do that, then in the event of a death payment, then the proceeds of the policy will be subject to income tax. So you have a choice. The company can say, I'm paying 1,000 Rand a month, it's 12,000 Rand a year. Am I going to claim it back from SARS as a tax deduction? If the answer is yes, then if the key individual dies and the insurance company pays out R1 million, that R1 million is going to be subject to income tax. Okay, so that is the choice of the business. Okay, so many businesses opt to claim the premium back as a tax deduction. Some business opt not to claim the premium back as a tax deduction. That's the biggest difference between the key person policy and the contingent liability policy. Okay, the other thing is here, if the key individual becomes deceased and the R1,000,000 pays to the company, if the company uses that million to go and recruit another key individual, and let's say, for example, they spend 500,000, that entire 500,000 is another tax deductible expense for the company. Expenditure in the production of income, section 11A. Okay, so that's another tax deduction if they use it to actually go and recruit another key individual. But we've got to be real here. The company can pretty much do with the R1,000,000 whatever they want. Okay, so the purpose of the policy is to go and recruit someone else. Let's say, for example, they spend 500 grand, they go and recruit another key individual, they left with 500 grand, they can actually go and invest that 500,000, which is the balance. Or they can use the 500,000 to pay out bonuses. Or they can use the 500,000 to settle debt. So this is all company property, and they can decide what they want to do with the proceeds of the policy. Okay. What's the advantage? Money is available to sustain the business financially, source another employee, or to train an existing employee with similar knowledge or skills. The reality is, some businesses might have to be closed down if they lose that specific key individual. So this is another product to protect the business. Okay, and that's basically just a summary of everything that we've just discussed. So just like the contingent liability policy, there is also estate duty on the key person policy. So if it's R1,000,000, it's 250,000 payable to SARS. These policies are not exempt from death taxes, estate duties. If you want R1,000,000 net after tax, you need to insure the key individual for 1,250,000. Okay, that's unfortunately how it is. Okay, no capital gains tax on these policies. And again, this is company-owned policies. It belongs to the business. The business will profit from these type of products. So I have had a couple of conversations in the past where I've actually had meetings with the shareholders and the directors and the key individuals. And the key individuals told me, Dwight, we've heard now all your smart stories and your smart suggestions. It sounds to me like when I die, the business will get money. What's in it for me? And I told these key individuals absolutely nothing, my friend. Absolutely nothing. And then they'll tell you, I'm not interested in this because the business is going to profit. I'm not going to profit. You know what I do then? Then I will tell them about this. Okay, this is my preferred compensation. So this is where I tell the key person, Mr. Key Person, you know what? Let's invest money for you. Since you're not receiving anything or your family is not receiving any benefit out of the key person policy, what if we do an investment for you for 5 years? And after the 5 years, we do another 5 year investment and another 5 year investment. Now I've got his attention. Okay, because there's something in it for him. So how do I do this investment? This is a key person. I'm going to give him a salary increase of 5,000 Rand, for example. Okay, we're going to use the 5,000. We're going to invest it each and every month in an endowment 5 year term policy. I'm going to do a security session to the employer just to make sure that the key person doesn't run away with the money after year 4. After the 5 year period, the employer is going to cancel the security session and the key person is going to receive his lump sum. free of tax after the 5-year term. Okay. These policies should be exclusively funded by the employer via the salary increase. There's no salary sacrifice for this key individual. The loss of this key individual is minimized. Why? Because if he resigns within 5 years, he's going to forfeit his money. He's going to forfeit his investment. And the deal that we signed is, Mr. Key Person, you're gonna work for me for the next 5 years. After 5 years, I'm going to cancel the security session. Then you can take your money, and only then. So this guy is not going to resign, at least within the next 5 years. And if he breaches the contract, the employer can merely keep the proceeds of the investment. Okay, so again, just like the living buy and sell, the 5,000 Rand salary increase is a tax deductible expense for the business. So this is a win-win situation. The company is giving this guy 5 grand salary increase. Yes, the company is spending money, but because it is fringe benefit tax in the key person's hands, the company qualifies for tax deduction for the 5,000 Rand monthly salary increase. Okay, so the company is winning. Yes, I'm spending 5 grand, but I'm getting it back from SARS on an annual basis. How is the employee winning? After 5 years, he's going to receive a lekker lump sum to the amount of 600,000 or whatever the case may be after tax. So it's a win for the employer and it's also the win for the employee. Okay. So in a nutshell, that is how I market these preferred compensation policies to the business owners and also the key individuals, directors, and shareholders. Okay. Do we maybe have any questions on the preferred compensation policy?
Dwight, I'd like to know, in the hands of the employee, the tax on the benefit, he will only be liable for the tax on that fringe benefit then.
Yeah, so the 5,000 Rand is gonna possibly put him in a higher tax bracket. So all we do is we enhance the premium. So if we wanna invest 5,000 Rand, we need to know what is the marginal rate of tax of the employee. Let's say it's 30%. So now we increase the 5,000 Rand with 30% to make sure his net take-home salary is exactly the same. So let's call it, for example, 5,300 Rand. So the extra 300 Rand is for SARS, the 5,000 Rand is after tax for the investment premium. So once we have the employees at a marginal rate of tax, so that entire 5,300 Rand is a tax deductible expense for the employer, and the employee takes home exactly the same salary that he took home prior to the salary increase. So he's not losing any money.
Thank you.
Did I answer you there, Crystal?
Yes, we do have a question here back to the buy and sell side, if I understand correctly. It's regarding a sole owner of a business.
Yes.
Does the company shares, does it automatically go to the client's wife, for instance? Or where does a will come into this?
Yeah, it depends if he has a will. So if the client, the sole owner, has a will, and most of the time the will is going to say, I bequeath the residue of my estate to my wife, okay? Then everything will go to his wife. If the sole owner has entered into a buy and sell contract with, for example, a third party, let's call it a manager of his business or an employee of his business. Once there's a buy and sell contract, the executor will transfer everything in the estate to the wife except the business. The business will go to that third party, which could be a manager or an existing employee in terms of the contract. If you've got no contract, everything will go to the spouse. And most of the time, the spouse is not involved in the business. The spouse has no skills to run the business. This is why it's important, especially for those sole owners, to try and get someone in that business to take over the business in the event of their death, and to make sure that they don't get the business for free. Okay, so only way to do that is to ensure that business owner's life for an X amount, that manager or that employee can pay the premiums on that policy so that we can make sure that if that business owner dies, R1 million is payable to the manager or the employee. He's got the cash to buy out your entire business out of your deceased estate, and we sign a contract while everyone is still alive.
Right. I know from clients that are sole owners, one of the biggest concerns is the time it takes to transfer everything over to the wife, for instance, who might be part of the business or not. And if it goes via the estate, it could end up sitting there for months and months and months. Does it make sense to have a buy and sell agreement, for instance, with your wife? Will it escalate the matter that the transfer happens more quickly than going through the estate route?
No, definitely not. So buy and sells is not allowed between husband and wife. So there's not one insurance company that's going to give us cover for buy and sell policies between husband and wife. They're going to state there's no insurable interest. Why do they say that? They're going to tell me, Dwight, I'm not going to give you life policies for this. You can merely just bequeath your business interest to your wife, and she can inherit it free from any taxes. So once the business interest goes to my wife, there's no estate duty on the business interest. There's no capital gains tax on the business interest. So it's going to be impossible for us to get cover for husband and wife on business interest.
Thank you. Another question is, what is the importance of these buy and sell contracts in this whole discussion and plan in order to practically implement this? Is it necessary, or is it well sufficient?
Yeah, so so it's very important to at least get the contract. And for the clients, I mean, you're not paying any money for it. So get the contract and get it signed to make sure it's legal and binding. If there's no contract, then there's no obligation for the executor to transfer the business interest to the people that are still alive. He's got no obligation to do that because he's got no contract. So the remaining business owners also have no obligation to buy your business interest because they didn't sign any contract. So I would absolutely stress on the importance of signing a buy and sell contract because it's going to supersede your will. Okay. So the will can say, I leave everything to my wife. However, if I sign the buy and sell contract, at least I'm going to get the business out of your estate. I'm going to pay cash for that money, and I'm going to ensure that everything is enforceable and all parties are obligated to either buy or to either sell. So very important to have a signed buy and sell agreement.
Yeah, from personal experience that I've seen from clients that didn't have these contracts in place, then the one party did not pay over the money to the deceased estate. So that is very problematic. A question that I've got also is there, if you can't afford to address all these needs at once, is there a specific order to implement these solutions, or is it very much from case to case?
Yeah, it varies from case to case. I'm gonna be honest with you. For me, the most important one is actually to take care of the succession planning. That's your buy and sell, and also to address the debt of the business. That's your contingent liability. If those two are covered, then I would be very comfortable going to bed at night because then I know if I die, the business is going to go to the people that it needs to go to, because remember, you still have employees to pay. So I don't want the business to stop and people to lose their jobs. Then I know the people that's going to run the business will actually get the business. They're going to pay the life insurance proceeds, the life insurance proceeds to my estate. So my estate is going to be liquid. I can pay SARS, I can pay the executor or all my other debts, and also the people that remain behind is going to have no more debt. So the debt we had from whichever bank is also going to be settled because we had contingent liability policies in force. So I would say those two are for me the most important products to have in a business. Make sure the debt is paid. Make sure the business can carry on if someone becomes deceased.
Right. If I don't see any other questions, maybe if somebody else has got a question, they are more than welcome to share. But if not, thank you, Dwight, for your expert legal advice. Appreciate the time you've given to us, and please, it's good to know that we can provide solutions to the needs that affect business owners. We remind everyone to book an appointment on the link on our website or the link in the information provided below for our specialized advice on these instances. And also the recording of this webinar will be available on our YouTube channel soon. So thank you everybody for joining, and we'll keep you up to date for our next session. Thank you very much. Bye.
Thank you. Thank you so much, everyone. Have a
Bye.
lovely
Thank
afternoon.
you.